Shall we update the participants?
Yes, we can.
Yes, sir.
So shall we start the session? Your attention. Shall we start the session? So the recording has started.
Is that for me?
Silva, start பண்ணலாமா?
Yes, sir. You can start, sir, please.
Respected Chairman in absentia and the Secretary of SIRC of ICAI in absentia, I welcome all the participants of today's program, with chief guest being Mr. Akil. I welcome you all for this a new concept which has been developed by our SIRC chairman, weekend programs. This has been a hit as far as the participants and other feedbacks are concerned. This is a weekend morning session on Ind AS. Today is that is the program. And the speaker of the day is Mr. Akil Master. And his background is Akil has joined KPMG in India in 2008 and has over 16 years of post-qualification experience in auditing and accounting practices. Akil specializes in accounting, change, IPO listing, finance transformation, and financial statement preparation projects, and has assisted several companies in India, US, and in the Middle East. Akil leads the IFRS Convergence Initiative for the Saudi India corridor and assisted over 30 leading listed companies and promoters in groups in Saudi. Akil also leads the FSH solution for CFO advisory, where he assisted large investments, banks, and fund administration in preparation of financial statements for mutual, hedge, and private equity funds. Akil was the regional project manager of Asia Pacific region for a large MNC automotive companies, IFRS conversion projects. He oversaw the transition of approximately 35 legal entities spread over 14 countries: China, Australia, Malaysia, Thailand, Japan, South Korea, India, among others. Akil is an accredited US GAAP IFRS resource person, and he has been a trainer in several US GAAP and IFRS trainees for clients as well as internal staff. During his tenure in New York, Akil was involved in US GAAP audit of large accelerated SEC registrant. Akil was also the lead project manager for IPO advisory project in the US market for a leading Indian telecom based company. With this, I introduce Mr. Akil Master. Sir, the floor is yours. I'm very happy that the people have largely participated in this program and has been recipient of a good initiative by SIRC. I thank you all for this opportunity. Thank you, sir. Sir, the floor is yours, sir. You can continue. Thank you.
Thank you, Ramaswamy, sir. Good morning, everyone. All of you are safe and healthy in these continued difficult times. We'll start with Ind AS 115, a very great initiative by ICAI. First thing on a Sunday morning, I think all of us would be fresh enough and hopefully have a very absorbing session. What we can do is you can ask me questions as we go, or we can leave it for the end. I leave it up to you all. I have close to 40 odd slides to walk you through the whole standard, and I'll speak about examples as well as whatever real life scenarios we have seen, and we can make it as interactive as possible. So I'll share the presentation. Right. I'm hoping my presentation is visible to everyone.
Yes, sir.
Yeah. Okay. So Ind AS 115 is the standard for revenue standard. It replaced Ind AS 18, and to this standard did take some time for it to be drafted. This revenue standard was a joint collaboration between FASB, the US GAAP Writing Authority, and ISB. US GAAP predominantly had a lot of literature on revenue, and as most of you may be aware, IFRS or Ind AS, and sorry, I might just call it interchangeably, but I mean Ind AS only. US GAAP predominantly has been a rule-based standard, whereas IFRS has always been a principle-based standard. And when we say principle, you use your professional judgment as well as your professional skepticism to make that assessment and take a viewpoint. So many say that you have more room to wriggle in IFRS vis-a-vis US GAAP, where it is very rule-based. It is or it is not. It's as simple as that. So this was a joint collaboration between FASB and ISB, where, in my personal opinion, it was more of a walk for IFRS to move towards US GAAP rather than US GAAP moving towards IFRS. So a lot of these concepts, if any one of you has practiced US GAAP, you might find it very familiar in that perspective. And we'll go through some of these points as we walk through this slide deck. So it's basically covered over 7 points of scope and objectives, how the what the new 5-step model in revenue recognition is, what are contract costs, what is contract modification, some of the important concepts within the application guidance, disclosure, and finally we'll summarize with the key learning points. So this revenue standard basically covers all goods and services which are sold by an entity to a customer for which consideration is received. This standard has, or rather is not applicable for certain transactions where a separate standard is available, and to name them is lease contracts for Ind AS 116, insurance contracts, which is Ind AS 104, and now hopefully Ind AS 117, financial instruments within 109, and any other non-monetary exchanges between entities in same line of business. On 116, there is a reference for Ind AS 115, especially in sale and leaseback transaction. So where the sale leg of the transaction is, it directs you to 115 to ensure that the sale is made in line with 115. That was not the case in the earlier lease transaction. It did not make you go back to Ind AS 18 for that matter. So the new revenue recognition model, they basically it divides it into 5 steps. You need to follow the 5 steps. So the most important change which has come in is identifying the contract with the customer. Identifying the contract was not per se a gating question earlier in the revenue recognition standard. So once the first thing out here, and we'll speak of some of the challenges which are faced, and especially how it is a little different from US GAAP for that matter. Identify the contract with customers. Second step is identifying the performance obligations in the contract. So what all promises you have made to perform within a contract. Then you determine the transaction price. Once the transaction price is determined, then you allocate the transaction price over the individual performance obligations, and thereafter you recognize revenue for each of those performance obligations at a point in time or over a period of time. So for all revenue recognition transactions, you need to follow this 5-step process. So as I mentioned, that identifying contract is now like a gating question, that you need a contract in place for revenue recognition to start. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. It can be written, verbal, or implied based on an entity's customary business practices. Now, these last 4 words are very important. That what is the entity's customary business practices? So if you as a company have a policy that a contract is valid only if it is signed, then that is your customary business practice. And you will recognize, or rather start recognizing revenue once the contract is signed. If your customary business practices, even if it is a verbal confirmation, and as far as it is enforceable in your local jurisdiction, you can also start recognizing revenue. So one jurisdiction we had come across, which kind of allowed that if I send a proposal to an entity to provide, say, advisory services, and the person does not revert back in 15 days, then it is assumed that the entity has accepted my proposal. Now, as far as it is enforceable by law, then in that perspective, it is a valid contract. Now, here's the subtle difference with US GAAP. US GAAP, generally, companies prefer having a signed contract. So earlier, US GAAP had a concept called as VSOE, vendor specific objective evidence. and that required the contract to be signed. So earlier, rather, a lot of companies, even though contracts were delivered, or rather whatever was underlying within the contract, it was all delivered, but only because they were not formally signed, it would show up as unbilled revenue to that effect. And but now, with this transition coming in, many companies are now starting to recognize revenue, and they're following this entity's customary business practice. Customer is any party that has contracted with you to obtain your goods or services as an output of your entity's ordinary activities in exchange for consideration. So that we all are familiar with. So to identify the contract with customer, this is also a change from Ind AS 18, that as part of whether you have a contract in place, there is a gating question on collection of consideration is considered probable. Earlier, it used to be part post your risk and rewards assessment, but now it's become a gating question itself, that whether you have a contract in place. So if collection of consideration is not considered probable, you don't have a contract in place in the first perspective. Second point, rights to goods and services and payment terms can be identified. It is very, and some of this is applicable when organizations use different types of contracts or agreements. In some cases, people use an MSA or an SOW for that matter, to see when you actually entered into a contract. So you may have an MSA which may define payment terms, but the SOW might lay down the scope of work. So you need to evaluate what is the contract or a set of agreements which will be looked at for a contract to be in place. And a contract exists if it is commercial substance that is in line with Ind AS 18, and it is approved, and the parties are committed to their obligations. And this is going back to the earlier slide, that what is your entity's customary business practices and whether it is enforceable by law. Moving on to the step 2, what are the performance obligations? Let me just So a performance obligation is a promise to deliver goods and services, and there are 2 criteria to it, and it needs to meet both the criteria. The first criterion is, can the customer benefit from that good or service on its own or together with any other resources available with the customer? And the second criterion is the promise to transfer the goods or services separately identifiable from other promises in the contract. You need to meet both these criteria to go ahead and identify a distinct performance obligation. When we started off with this whole Ind AS 115, and as the standard was new and there were not enough precedents available, there used to be a lot of debates on what a performance obligation was. A lot of people ended up identifying a lot more performance obligations than it should have. But as the standard got used, and as across sectors and industries, certain positions were made, I think the second criterion really helps in terms of identifying whether there is a separate identifiable promise from other promises in the contract. So if you meet both the criteria, then yes, you have a distinct performance obligation. If not, then it is not distinct. You combine everything and say that one single performance obligation you have. let's look at this example. Company X enters into a contract to design and build a hospital. X is responsible for the overall management of the project and identifies various goods and services to be provided, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. How many performance obligations are there? If I could open it up to the participants. And why? Any takers? So on the chat, I'm seeing 2 or 3. If anyone could come, ma'am, is it possible to unmute if people have to speak about it?
Sir, we can have an hand raise option so that all the members can participate in it.
Sure. So
So if any member want to ask a question, they can raise their hand and I will unmute them so that they can answer, or at the end we can have it, sir. Now we can go through the chat and we'll have it. Otherwise it will be like time consuming, sir.
Sure. So yes, I see multiple answers from 1, 2, 3. So in this perspective, is only single performance obligation, and the whole reason behind it is that the second criterion is not met because there is individually it does not. So if you look at the second criterion is the promise to transfer the good or service separately identifiable from other promises in the contract. So out here, the promise is to build a hospital, and that is the whole single performance obligation which you have. And the second criterion is not met on that ground, even though you may believe that there are several promises right from engineering, site clearance, foundation, so on and so forth. But as it is, there is significant integration involved, the second criterion is not met and would be treated as a single performance obligation. Let's look at a second example. All right, I kind of showed the answer itself. So in this, a customer enters into a contract with a mobile service provider to obtain both mobile phone as well as services for INR 150 monthly for 2 years. Without such a contract, a customer can buy the same mobile phone in a standalone basis for INR 600. Also, standalone price for mobile monthly services costs INR 125. How many performance obligations are there? Here, there are 2 performance obligations, one for the sale of mobile phone and the other for provision of service. As individually, each sale of mobile phone, they can be identified separately as well as consumed independently from it. The customer does not necessarily have to buy the phone to use monthly mobile service and vice versa. So here, the option to have 2 separate obligations or other consume it in 2 different obligations is possible, and you would have 2 performance obligations where one sale of a mobile phone would be recognized at a point in time, whereas provision of service would be recognized over a period of time. Moving on to the third step, determine the transaction price. So all your variable considerations which are involved will be included out here when you determine the transaction price. And this is the consideration payable to a customer, and you would remove any kinds of discounts, bonuses, or rebates you give as part of it. But if you're obtaining another goods or services from the customer, then that is treated separately as an expense item from you and not to be adjusted as part of the transaction price. And if there is any significant financing involved, then you look at, you carve out the financing component as a separate performance obligation. So not necessarily a performance obligation, but you calculate the financing impact separately. So let me give you an example on the second point of consideration payable to a customer. We've seen in case of FMCG or other supermarkets where people are selling their products, and so say Unilever is selling its products in a supermarket, they would get the revenues from all the products which are sold. They might end up giving any rebates which would be based on volume basis. But at the same time, Unilever may be paying a price for the shelf also, just only for where the product is positioned. Now that could be treated as a separate distinct good or service, where it is leasing of space from the supermarket in what we call as gondola space, and it may not be adjusted against the transaction price. That would be treated as a separate rather service in that matter and computed separately outside the transaction price. So variable considerations can be discounts, incentives, penalties, performance bonuses, and rebates. One of the bigger changes which we have seen as part of Ind AS 115 is also on penalties. Earlier, under Ind AS 18, you would see penalties being recognized much more closer to when they are kind of enforced on you. Now, if you are entering into long-term, any say construction contracts or anything of that sort, where after 6 months itself, you believe there is going to be delay in the project, you start recognizing those penalties, i.e. start building it into your revenue amount itself. You start reducing that amount rather than wait till the end to go ahead and recognize that penalty and have a reduction of revenue. And to estimate the variable consideration, there are two methods which are usually used. One is what we call as expected value, where there is high number of homogeneous transactions, as well as the most likely amount where transactions are lesser. So we'll take a example for it. Another very important thing within transaction price is where it should not lead to a significant revenue reversal, and where there is a high probability, right? Now, significant revenue reversal, as it is IFRS, it doesn't define what is significant. So that is left to your professional judgment. That if say 100 is the revenue and it leads to a 10% revenue reversal, is 10% significant, right? That is an assessment, a judgment which you need to make, that could it impact, and I think it will boil down to the whole profitability scenario as well, and determine what is significant revenue reversal. And high probability, probable in IFRS is usually 51%. Highly probable, we tend to give it a weightage of 75%, which is highly probable. And please, uh, the terms like more likely than not, probable, they have very different weightages between US GAAP and IFRS, right? We have a raise of hand. Gohan, you want to go ahead? Can we unmute Gohan?
Yeah, yes, sir, yes.
Gagan sir, you can ask your question.
Gohan?
So we'll go ahead with the session, sir.
Okay. So this is a very important concept while determining your transaction price, that it should be at a level where you do not have a significant revenue reversal. And if there is a high probability of significant revenue reversal, you do not go ahead and recognize that revenue. So let's take this example. There's a contract to build a jet for a customer. The transaction price includes a fixed amount of 100. There is a completion bonus of 100 if completed 2 months prior to a specified date. And there is a performance bonus between 0 to 100, depending on the number of flights in its first 12 months of service. The question is, how do you estimate this variable consideration? So in fixed amount, is there any kind of variability? I think that's an easy one. There is no variability in the fixed amount. Now, coming to completion bonus, is it expected value which you will use, or the most likely amount in this case? So when we spoke earlier, we mentioned that you use expected value where there are high number of transactions. You take a probability assessment and see where do you land up. Whereas most likely amount is where there are fewer options, and you say what is it you will come up with. So in completion bonus, either you get it or you don't get it. There's no variability involved. So either you get 100 rupees or you get 0 rupees. So you make that assessment based on what is the most likely amount. Whereas in case of performance bonus, where there is variability involved, that how many number of flights will take place within the first 12 months, you will estimate the expected value, taking those probabilities into consideration. Okay, we have another raised hand. Can we unmute Shiva? Ma'am? Yeah, Shiva, go ahead.
So with respect to the performance bonus, does this also include like for the sales employees, we give a certain target, right? So in the year end, if they achieve the annual budgeted budget or amount, their measurement is on the sales. The performance will be incentive will be given based on sales achievement. Will this be also included as performance of
So,
consideration?
so this is where the company gets a performance bonus for providing the product. In case of your employees, we'll come to the next slide where we talk about contract costs and see what contract costs need to be expensed as well as capitalized. So that is you incurring a cost to make the sale happen.
Okay.
Yeah, Vipin, go ahead.
I just have one more doubt.
Sure.
I ask, or
Yeah, please.
so let's say that my sale is on FOB. It's on what, how to say? It's not on X work basis.
Okay.
My commitment is still the goods reaches the customer's place. It's my responsibility.
Till the customer's place.
Yeah.
Okay.
So in my price, my invoice price, there is no separate component for freight. My price is including the freight component.
Okay.
So is there any requirement that I need to separately show the freight, or is it necessary, or the both will be considered under revenue?
So I think that's a good question. And I think some of this, you go back to your customary business practices, that do you actually show freight separately for that matter? And many a times where there is also a case where freight is treated as reimbursement of cost, right? So you apply the principles of the concept of gross versus net accounting. Right? So in your case, if most of your dealings are till the customer's warehouse and freight is always included within it, you could take a position of including it as part of your sales and treating freight costs separately. There would be questions around, is there margin involved on freight? Or you're just taking it cost to cost? If it is a cost to cost scenario, you might have questions in terms of, then do you treat it as reimbursement of costs? So whatever freight costs you're incurring, you net it off against your revenue itself. So I would look at it from that perspective.
Okay.
Yeah.
Thank you.
Thank you. Yeah, Vipin.
Hi, sir. This case of estimating variable consideration and this performance bonus, especially on the performance bonus, we do a kind of lot of probability analysis and then conclude whether I can account for that revenue. So is there any specific documentation for every such contracts we need to do any specific kind of documentation or supporting, or how do we go about analyzing and concluding that something can be recognized as revenue or not? And first one. And second one, suppose we are decide to record this as a revenue right now based on the probability assessment. Subsequently, it doesn't turn out so. How will we account for this transaction when subsequently we realize that this is not going to happen?
So good question, Vipin. And I'll take your second part first, which is what if you don't recover that revenue? So I think if I'm the auditor, I will look at more closely your estimation process. Okay. So if I were to go back to, so does it lead to significant revenue reversal? Okay. So if it is a significant revenue reversal, we have a problem. And that it should not be highly probable that the significant revenue reversal will happen. So you need to have that balance between a conservative position as well as an aggressive position. As far as it does not lead to a significant revenue reversal, I think you'll be good on your estimation process, because this goes back to management's estimation. So it's a little more deeper than the fact than only reversal of revenue, right? That it gives out a practice saying the management is always very aggressive in revenue recognition, right? As far as your documentation question is concerned, yes, you need to have a proper working in terms of, if say it is 0 to 100 and you come to a number of 80, how did you come up with that 80? What were the assumptions you took? And the normal validation of assumptions would happen from an auditor's perspective. But as management first, you need to be very clear in terms of what assumptions you are taking, right? And there has to be that proper documentation of working, that why 80 and why not 75 or 85 is a simple thing. That's the piece of documentation what you require. Hope I have answered. So moving ahead. Oh, sorry, we have Sai Kumar also.
Sir,
Yeah.
Actually, we entered a contract export of goods for a certain amount. After completing that contract, we will be receiving some percentage of share on profit on sale of the exported goods. How do we ensure to recognize the revenue? Is it a combined contract? Is it a separatable contract?
So it's not a separate performance obligation from what I hear. It's all about determining the transaction price. So you need to estimate when you were recognizing that revenue, that how much percentage of that profit share you were supposed to get towards it, and start recognizing.
Suppose if I take it is 50% of share on the sale of the goods from the export of goods. How do we recognize after export of goods? This contract is not separable. It is combined. There is two things. One is on I export goods. Second one is I also get a percentage of 50% of profits on sale of the goods from the foreign location.
So that's what means. You treat it as part of that 50, that whatever profit share you're getting, you treat it as part of your transaction price. So as and when exports are happening, you recognize as part of those exports, right? The only question is that today you have made an assumption of 50%. Say at the end of the year, when you do a true up, you get 10%. Then it goes back to my earlier point, that is there a significant reversal of revenue? Okay. And you need to watch out for that. On the other hand, say you recognize another 40%, say 90% of that profit share. So the 40% adjustment comes at year end. That also is an issue, that you went too conservative. So you need to find a balance to it. Or the other argument, which will still hold, and is the high probability of this uncertain event, right? How much you will get, you are uncertain about it, and you can take that position and not recognize anything. But the moment you start recognizing something, then yes, there is that certainty of that event to occur, and how your estimation process has gone ahead. Does that answer?
Yes, understood.
Yeah. Yeah, Venkatesh. Can we unmute Venkatesh?
Yeah, so they can unmute themselves. I asked them.
Hello, sir. Are you able to hear me?
Yes, I am able to.
Oh, thanks, sir. One clarification on the performance bonus. So we are using some probability methodology to analyze, to understand the expected value, but whether it's required to disclose any note or anything in the financial statement saying that is subject to performance, it will be realizable kind of thing?
So I think as far as you don't need to disclose the methodology per se, but if there is some amount of performance bonus which is being recognized, a line or two on that would help for the reader of the financials to know that how much is always fixed revenues and how much is their variable component involved. That's about it from a disclosure standpoint. I wouldn't go and expand on how did you come up with the weighted probability and so on and so forth. Does that help?
Okay.
Venkatesh?
Okay.
Yeah.
Yeah, it helps. Thanks a lot. Thank you.
Thank you. So moving ahead, on significant financing component. So very often we see now a lot of financing options available, and it's kind of inbuilt within the price of the, so wherever we see this 0% EMIs transactions, where basically the price at what it is sold to you, even if it is paid in installments, there is no uptick in terms of the cost to the product, but there is a pricing or a financing component involved in it. So one good thing is there is a practical expedient that where the financing is for 12 months or less, you don't need to make this adjustment. But if the financing is more than 12 months, then it is deemed to be material and you need to carve out that financing component and show it separately. The biggest reason is, one is it does not form part of your revenues and it will possibly show up as other income in terms of financing. So that's one area. The discount rate you ideally would need to take for discounting of that financing is what that entity or that or rather the customer would be entitled to had it gone outside to get a loan. Most of the times it is not so easy to know what's the financing, and as there are especially in FMCG products, as it is offered, say or consumer durables also, TVs and stuff like that, it's individual customers. Usually you tend to use your own entity's incremental borrowing rate, because as you're blocking cash into that, you might have to go to the bank and get more additional money. So it's a safe bet to take your own company's incremental borrowing rate for that amount and tenure to use for discounting those cash flows and identifying the financing component to it. But usually we see the financing to be less than 12 months, and most organizations take the practical expedient for it, and they don't go ahead and carve out the financing element from the revenue price itself. Okay, now this is, I believe, the most critical part of this revenue standard, is that first we identified the contract. Once we identified the contract, step 2, we identified the performance obligations. Once we identify all the performance obligations, we determine the transaction price, that what is the overall transaction price. Now is the fourth, and this is where most of the say positions being taken come through. And here in this step, basically whatever performance obligations you have identified, you allocate your transaction price within those performance obligations. Okay, so a very simple example you can see within IT services is where you sell hardware, you sell software, and you sign up for an annual maintenance contract also. Okay, usually 3 things are sold together. And a general analysis of these three components is hardware would be recognized at a point in time, software would be over a period of time, and AMC also over a period of time. If there is significant customization of the software license, then you again would end up with an over a period of time, but using percentage of completion method to go ahead and identify how much revenue needs to be recognized. Now, when you do this, when you have multiple performance obligations, to allocate the transaction price, you first have to determine the standalone selling price of that individual performance obligation. Now, what is standalone selling price? Is as it goes by its name, that if you were to sell that hardware as is, only the hardware, at what value would you sell? If you were to sell only the software license, what is the value you would sell at? So the best evidence is the observable price. Observable price is one, what you sell at. Okay. And say for any reasons, you don't sell on a standalone basis that item, say the hardware item, but most others in the market actually sell it on standalone basis also. Then if you don't have an observable price internally, you look at it in the market perspective, right? So in that case, you estimate the price. So whatever is the adjusted market assessment approach is what we call it, that how much the market sells it for. Or two, you take a cost plus margin approach. Okay, so whatever the cost of hardware is, you assign a margin to it. This method is called as the relative fair value method. Okay, now earlier in US GAAP, and for that matter in IFRS also, there used to be a method called as residual approach. In this also, you still have the residual approach, but it's the last approach which is available to you. Residual approach is where you determine the price, standalone price of the undelivered item, not of the delivered item. Okay, so to give you an example, and carrying on from my earlier example, that if someone were to play on the revenue numbers or the profitability, say I'm selling hardware, software, I'm customizing software, and I'm selling AMC, right? If I want to front end my revenues or improve profitability, I might allocate maximum amount of revenues as well as margins to hardware, because that is at a point in time. The moment I deliver the hardware, my obligation is over. So I can front end my revenues and my profitability. At the same time, say AMC, which will only start once I complete the customization of software, everything is done, and then the maintenance period increases. That is going to be at the bottom half of my contract. So I might allocate the least amount of revenues and margins to it. So in that case, say the customer or the company decides, okay, I need profitability, I need revenues. Let me play around this aspect. So whatever is undelivered, if you determine the standalone price for it, then you are one way ensuring that whatever is delivered will be on the lower side. Because then it is, even from an auditor's standpoint, from a residual method perspective, whatever you will always look at that AMC aspect and be able to determine what the standalone selling price is and what are the appropriate margins involved in it. And most people would know AMC usually has the highest amount of margins involved in it. Earlier, maybe at least a decade ago, there used to be a method allowed called as reverse residual method, which is nothing but where you were required to determine the revenue of the delivered item. So there it used to enable companies to go ahead and front end a lot of their revenues, right? So reverse residual method is no longer allowed. Residual method is allowed. So usually what we see in terms of how companies use the method out here where multiple obligations are involved, one is what we call as the relative fair value method, and most companies would have their own observable prices if they were to sell it on a standalone basis. Two, instead of market, they generally tend to use a cost plus margin approach. And third is the residual approach, which is used. So let's look at this example. And maybe you all can help me how to go about this. So company T enters into a 1-year mobile contract from which a customer is provided with a phone and a data calls text plan for a price of 35 per month. T has identified the phone and the wireless plan as distinct performance obligation. The phone can be purchased on the manufacturer's website for a price of 200. And T offers a 12-month plan without a phone that includes the same level of data calls text for a price of 25 per month, providing an observable evidence of standalone selling prices for both the obligations. So basically what T has done is that to sell both together, they have sold it as a package at 420 rupees, 35 into 12, 35 per month for 12 months. But if they were actually selling it on a standalone basis, that the phone separately and the mobile service separately, they would have got 200 rupees for the phone and 25 per month into 12, 300 rupees for the mobile service. So 200 plus 300, 500, they would have got as part of this contract if it was sold separately. In essence, they have given a discount of 80 rupees. Now the question is, how does this 80 discount get allocated between two? Because remember, there are two performance obligations. One is sale of mobile phone, which is at a point in time. And two, there is mobile service, which will be over a period of time. So how do you allocate the 80 rupees of discount between 200 and 300? So basically you use your selling price ratio. So 200 by 300, so which is 40-60 ratio. You apply that 40-60 ratio on your 420. So 200 is 40% of 500, 300 is 60%. Similarly, you take 40% of 420, which is 168 as price of the phone, and 60% of 420, 252 as wireless, which you would divide over 12 months. Okay, this is the relative fair value method. Okay, the other approach, so your determination of 200 and 300 is your observable price, what we spoke about. If you wouldn't have an observable price, you could have taken a cost plus margin to determine what's the price of phone and what's the price of the mobile wireless service. Or if you were to go to the residual approach, then say if you determined the fair value of the undelivered item, which is wireless, phone to you would have delivered, right? Wireless service you will deliver over 12 months, which is the undelivered item. Identify the price of the undelivered item, which is 300. So 120 you would allocate towards the price of the phone. So you would recognize 120 at a point in time when you sell the phone, and the 300, the standalone selling price, you would go ahead and recognize over 12 months instead of 252. That is residual method. That you determine the price of the undelivered component, and whatever is remaining, you can allocate towards the delivered part of the performance obligations, right? Any questions on this? Here, this is the place where a lot of estimation happens, especially where you sell bundled contracts. A lot of bundled contracts have this issue, and I don't have it covered out here, but speaking of bundled contracts, I will speak about some application matters, what we usually see. So we have Subramanya Swara. Can we unmute him, please?
Yeah,
You
good
can
morning, sir.
unmute yourself, sir.
Yeah.
Yeah, suppose this contract, this service obligation is more than 12 months. Here, the how to determine the allocation of price? Suppose it is a 24 months, and if you allocate like this, for the future obligations, any discounting is required?
So there's no discounting required. Here you are using the standalone price. So instead of 12 months, you would have multiplied by 24 months.
Okay.
So 35 also you would have multiplied by 24 months.
But I am receiving price in advance, huh? For service obligation.
But this is for identification of your
Pricing.
individual price for the obligation.
Okay.
So there's no, because you are also, if you receive, if it's a prepaid plan, that the entire amount 35 into 24 you're receiving upfront and not over 24 months, then yes,
Yeah.
discounting impact could come in.
Yes.
I agree.
Thank you.
But if it is going to be paid on a monthly basis, then there is no discounting impact.
Yeah. Thank
Yeah.
you. Thank you.
Yeah, Murli, you can unmute yourself. You should be able to. Yeah. Go ahead.
Oh, sir, good morning, sir. Suppose in case of car service, car selling and other long-term items where we have warranty for about 10 years,
Okay.
their time value of money is also involved, right?
So you are selling extended warranty or as part of warranty?
See, my total contract itself, the selling price of the car is suppose 10 lakhs, which includes extended warranty for about another 2 years, which is altogether for 12 years. Maybe I will charge for the extended warranty another maybe 1% of the car value.
Okay.
So now for 10 years and extended warranty of 2 years, 12 years, how should I cover the warranty cost? Like, should I go for time value of money or not?
I have an example ahead. Just hold on for 5 minutes and then maybe you can ask that question again. I'll take that example.
Thank you. Thank you. Thank you.
Yeah, Venkateshwara, you can unmute yourself.
See, now presently we are getting all electrical cars where they are extending their warranty guarantee. They are giving for electrical battery for 8 years. So what is any accounting treatment is required?
Okay, so on this warranties, we have a separate application.
Can we say is it warranty or guarantee?
I know there is a difference between warranty and guarantee.
Yeah.
But in that case, then the only thing guarantee, if you were to literally take it, then does it allow you to recognize revenue? Could it lead to a significant reversal of revenue? So let me give you an experience. You're working with one client, and as part of our Ind AS convergence, as part of our Ind AS convergence, we tend to speak outside the finance department also. Especially on revenue contracts, we tend to speak with the sales and marketing team. And when we were speaking to them, one of the guys, one of the sales guys, he got up, and it was kind of a long service contract where they were kind of manufacturing a machine, and they'd given a lot of warranties and everything to it. And he said, listen, we have sold this one machine to a client where it said that if it stops working anytime within 12 months or anything happens to in 12 months, you can come and return it. No questions asked. And there, the conversation did not go towards a sales return. The conversation went towards, can you recognize revenue in the first place? And it was a customized machinery. It's not a standard machinery which they were selling. It was an absolute customized machinery. And as there was no history to it, the conversation went towards that line. That's the indication I'm trying to give you. That when you say guarantee, then you look at the assessment of whether there is highly probable event that this battery could come back. If it is highly probable that it will come back, then the answer would be you cannot recognize revenue in the first place. Forget coming to transaction price. Whereas in case of warranty, you can look at it from a performance obligation, which we'll try and cover ahead. But yeah, when you try and differentiate between warranty and guarantee, the methods or the conversations can go in different directions, is my limited point. Does that help? Okay, I'll move ahead. So then you come to the final step of, okay, sorry, I wanted to speak about bundle contracts. So let's take my example of hardware, software, and AMC. And we have seen this, that sometimes as this whole allocation has to happen separately, standalone price needs to happen separately. Sometimes companies tend to enter into 3 different contracts, one for sale of hardware, one for sale of software, and one sale of AMC. But the price negotiated would be as a bundled one only. Okay, so instead of, say, if I were to take this phone and wireless, okay, the company enters into separate contracts. For phone, it takes 300 rupees, and for wireless, it takes 200 rupees, and it writes as the transaction price. In that case, as there are 2 different contracts, one can say that becomes the transaction price for it. But what the standard says is that you look at some of these contracts where it should be bundled together if it is commercially negotiated in that manner. So it would have been negotiated at 420. It's just that for phone they put 300 and for wireless they put 120, right? In that case, what the standard says is that if contracts are signed separately but negotiated together, you still bundle them together. So you add that 300 and 120 together and then do the unbundling again. So go on the standalone selling price of phone and wireless, 200 and 300, and you'd still come to the answer of 168 and 252. Even though the contract may say 300 for phone and 120 for wireless. So the standard tells you in some cases where companies are trying to say front-end revenues for that matter, you please look at how they were commercially negotiated And as a way out, did they enter into separate contracts to come out of this whole concept and allocate, say, 300 towards the phone itself. So you need to bundle and then unbundle. Now this bundling concept, as a firm, our guidance is that you should bundle contracts even if they are up to a period of 6 months between each other. Okay, so you very tactfully, means say going step by step, you decide to enter in the month of August the hardware contract. Then after 2 months you do software, and then thereafter after 2 months you do AMC. What the standard says, the standard doesn't give this 6 months guidance. That's our firm guidance, but it says that if it is done over a period of time, some of these contracts, but they are commercially negotiated together, you have to bundle them together and then unbundle them. Yeah, so these are ways and means where people look at coming out of this whole allocation of transaction price, right? So that was one thing which I wanted to share. Now coming to recognition of revenue, yes, recognition of revenue, there are two ways to it. Either it is at a point in time or over the period. That's when you recognize. And basically it comes down to so the standard for over a period of time, it gives 3 criteria. If either one is done, is met, then you can recognize over a period of time. That the customer simultaneously receives and consumes the benefits as the entity performs. Okay, so you recognize over a period of time. The customer controls the asset as the entity creates or enhances it, right? So any asset which is built on customer site and it is work in progress, or the entity's performance does not create an asset for which the entity has an alternative use and there is a right to payment for performance to date. So any customized assets which you're making. Now, when this standard came out, there was a big problem for all the developers, where the point came up is, can they recognize revenue over a period of time? Because customer simultaneously receives and consumes the benefit of the entity performance, that is not met. Say you have bought a flat on 12th floor, means this is out of question. And the customer controls the asset as the entity creates or enhances it. So going back to my example, you have bought a flat on 12th floor, it is only reached ground floor. You don't have any control of the asset because no asset is made, but you'll be still paying for it, and the entity is receiving money and recognizing revenue on percentage of completion basis. They found some harbor within this criteria, that the entity's performance does not create an asset for which the entity has an alternate use, and there is a right to payment for performance to date. So as flat C1210 was sold to you, the company cannot or the developer cannot put an alternative use to that asset, even if you don't pay. First and foremost, it has to get that title back from you, and then only it can do anything. So the developer also has the right to payment for performance to date. So in that case, even though you had bought the 12th floor flat and work was done up to the ground floor, this criteria was not met, or rather was met, because there was no alternative use as well as there was a right of payment. If you meet any of these criteria, you recognize revenue over the time and not a point in time. Had this criteria not been met, then in developer's case, it would be at a point in time, and it would end up like a completion method for that matter. Let's look at this example. Entity agrees to build a specialized equipment to integrate with the customer's existing plant. Customer can cancel the contract on 30 days notice. If the contract is cancelled, the entity has a right to payment that covers costs incurred. Customer has agreed to make quarterly payments. Now, do the terms meet the no alternate use and right to payment criteria? In case of no alternate use, it does meet, because this is a specialized equipment made on customers' requests and specifications. So there is, if the customer doesn't get that equipment would be of no use to the entity where it can go and sell it to another customer. Now, in terms of right to payment, now right to payment, it says that the entity has a right to payment that covers costs incurred. What the standard says is that when you look at right to payment, it has to be including margin. It should not be restricted to costs incurred only. So whatever was due to you, if you are able to get it, then that right to payment clause is met. So if out here it only covers the cost and it doesn't meet the right to payment. So this would be at a point in time and not over the period of time. And this is a big change from Ind AS 18 perspective also, where there is a lot more clarity in terms of what is this payment. Is it only cost or is it cost plus margin? This is very similar to Ind AS 18 for performance obligations, and especially the percentage of completion method, the output method and the input method. There's not much of differences as compared to Ind AS 18. You would use the same methodology from that perspective. Sorry. Now, for revenue recognition satisfied at a point in time, you basically now risk and rewards is only one point within this whole concept of transfer of control. Is there transfer of control which is happening for you to recognize at a point in time? So one, there's a present obligation to pay. Two, have the legal titles transferred. Three, is there physical possession of the underlying goods and services. 4, risk and rewards of ownership. And 5 is the asset accepted by the customer. Once you meet these 5 criteria, then technically you can say transfer of control has happened and you can recognize revenue at a point in time. So earlier it used to be only the risk and rewards assessment for you to go ahead and recognize. Now it is one of 5 criteria, and you need to meet these 5 criteria for you to go ahead and say your transfer of control has happened. Okay. So let's look at this example. Company A offers various corporate services such as treasury, general advisory, legal related, etc. to its subsidiaries. The subsidiaries are billed for such services provided based on the time spent by each employee of company A. Rates differ based on grades, which is multiplied by rate per hour, including a profit margin. Company A is recognizing revenue at the end of the year and not the end of each quarter. Is revenue recognition in compliance with Ind AS 115? No, it is not in compliance with Ind AS 115. You need to recognize it not even on a quarterly basis, but on a monthly basis. And I don't think so our answer would be very different under Ind AS 18 as well. It gave you some leeways within Ind AS 18 where, say, from volumes and rebates perspective, when you were determining the transaction price, in Ind AS 118, we used to see that people tend to recognize some of those volume rebates at the end of the year. But under Ind AS 115, you need to recognize any volume rebate on day one itself. So say if you have a volume rebate of say 1% if over 100 units are sold. Earlier under Ind AS 18, you would estimate that volume rebate at the end of the year and go ahead and account for that rebate as net of revenue. Today, you have to recognize that 1% at the time of recognizing the sale of the first unit itself. So you estimate whether you are going to get that 1% or not. So there are a couple of ways looking at it. One, you can make an assessment saying it is still an uncertain event and I am not sure, I will not recognize. Whenever you have certainty over that event happening, you start recognizing that 1% for that matter. Okay.
Sorry to interrupt. Shall we have 2 or 3 minutes break, sir?
You want a break?
Yeah, participant has like requested.
Okay. Okay. So when do we join back again?
So I think around 8:52 or 8:53.
8:55. I mean 2-3 minutes to log off, log on my email.
So that they will
55. Yeah.
8:55 will turn back. Sir.
Okay.
Till that I will have the screen share. Thank you. Sure, I think we can start the session, sir. Thank you for your.
Right. So moving ahead, in terms of contract costs, and I think there was a question earlier in terms of sales incentives being given to employees. So contract costs are divided into two parts. One is cost to obtain contracts, and two, cost to fulfill contracts. Cost to fulfill contracts is simple. That is the cost to your revenue, and you will recognize it as and when it is incurred. Now, cost to obtain contract. Here, the standard tells you that if any incremental costs you're incurring to obtain a contract, you can capitalize them and recognize them as and when, if the revenue is recognized over a period of time, the cost you can also capitalize and recognize over that whole period of time. But it has to be incremental costs. So if you are paying any incentives only when a sale is made, then it is eligible. If you're going to pay, say, salary costs, irrespective of the sale being happening, then that may not fulfill the criteria of this cost to obtain contract, because it will not be any incremental cost. So I'll give you an example. Many companies say to attract customers, hold conferences, they gather customers, they make their sales pitch, and when they are leaving, they offer them some goodies. And sometimes goodies can be really good and it can be expensive from that perspective. So they do incur. Now, one can say that all this expenses I'm incurring is to obtain contracts or obtain new customers. It may still not be eligible because it's not incremental. You're going to incur this as is, whether that customer signs up or not. So if 100 customers come up and only 10 people sign up for it, you can't allocate that entire cost to that people. And you cannot take it on a proportional basis also, because that cost you would have incurred as it is, whether you get 10, 15 or 5. So some of those costs don't get eligible, but if it is direct and incremental in nature for every, so any cost you're incurring only if a contract or a sale is made, those costs you can capitalize, and if the revenue is recognized over a period of time, you can recognize those costs also over a period of time. So that should answer that question on incentives given to employees. So if your revenue is at a point in time, that cost, that sales incentive which you are giving should also be recognized and accrued for at that point in time also. It's just that you will end up paying him at the end of the year, but you will recognize that cost as and when that sale is made. Similarly, from a statement of financial position perspective, till the time revenue is received but yet to be delivered, you would show it as a contract liability. If you've incurred costs but revenue is not yet started to accrue, then you could end up showing it as a contract asset or unbilled revenue, as you may call it. So there's not much of difference from Ind AS 18 as far as recognizing an asset or a liability from the perspective. It's just that costs have been incurred or costs are not incurred, but revenue has been billed, not revenue. It has been invoiced. So you would show it as a liability, and where costs are incurred but revenue is yet to be recognized, you would end up showing it as an asset. Now, this is an area where quite a bit of judgment goes in, and you look at whether it is a contract modification or not. So the first and what we call it as change orders, right? The first and foremost is the contract modification approved. If it is not approved, you do not do anything. It goes back to the step one. There is no identified contract. You move on to the next bucket. Does it add distinct goods or services that are priced commensurate with standalone selling prices? If yes, if there are distinct goods or services, it is a separate contract. If it is not distinct goods or some services, then you look at, are the remaining goods or services distinct from those already transferred? So say if you were making a highway for 5 kilometers. Now the client has come back and told you make another 1 kilometer of highway. It is not distinct from those already transferred. You've already done that. It would still be part of the original contract. It would not be treated as a separate contract, right? It would come down because it would be determined out here as part of the original contract. It has to be distinct from whatever has been already transferred. And yes, if it is already transferred and distinct, then account for a termination of existing contract and recognize a new contract for it. So here, the impact of it is that, again, it goes back to the whole transaction price and allocation of transaction price, that when change orders come in, how will it be recognized? And all your implications will come in step 3 and 4 for that matter. So pre-contract modification may not be a separate contract. It could be just an extension of the existing contract, and you need to revise your transaction price to that effect and not account for it as a separate contract. So this is an area where a lot of professional judgment also goes in. Let's come to principal versus agent. This concept was there within Ind AS 18 as well, and generally borrowed from US GAAP perspective. So there are 5 criteria which you look at, and you make your assessment after going through these 5 criteria. It's not either or all also. You evaluate on these 5 criteria and then make an assessment whether you are the principal in the transaction or are you an agent in this transaction. If you're a principal in this transaction, you'll recognize the gross revenues. If you're an agent, you will recognize only the net revenue. A very common example is travel agents, right? Whether you treat the cost of the ticket as your revenue or only your commission, what you get from that perspective. So the 5 criteria which you look at is, does the entity carry the inventory risk? Does the entity carry credit risk? Who is responsible for fulfillment of the contract? Does the entity have discretion in establishing the prices? And is the consideration in the form of commission? Usually we see people getting trapped in the principal one is usually where they have credit risk, right? If credit risk is with the entity, then a lot of weightage is given to it from a principal perspective, even though it may not have discretion in establishing prices. But this is an area where we see most people getting trapped. Then it's your judgment you have to make to see what gets where you give weightage to it. The first 3 is where we give a lot of weightage, right? That who's responsible for fulfillment of the contract and do you carry any inventory risk? We had seen a very detailed analysis in case of an alcohol company. And if you are aware in terms of how the alcohol industry works in India, there are licenses given by state. So any top brands, if you look at it from an India perspective, they may not be able to, 1, manufacture into a state, and 2, also sell into a state. So they would have to go back to any person who holds license for manufacturing as well as selling. So they kind of outsource their entire say manufacturing and selling portion to one entity, and then the assessment is made whether are you the principal to the transaction or agent to the transaction. If you look at, say, any particular brand, you take it and I say I am a bottler, that is what I'm called as. I've been given the recipe to how to make that alcohol. I've been told where to buy the material from. I've been told where to go and sell it, how invoicing needs to be done. All invoicing would be done from my company's name, but then you would evaluate on all of this criteria. Then do they have inventory risk? Do they have credit risk? And the responsibility of fulfillment of the contract rests with whom, right? So that's a very detailed transaction which we had seen, where it kind of had an impact on their business model itself, only because of the local laws and regulations present in the country, where there are restrictions in terms of who can manufacture and who can sell within individual states, and whether so there are restrictions in terms of manufacturing in one state versus selling in another state as well. So they had to sign up with different bottlers to do that as well. So yes, you look at these 5 criteria together, give your weightage and look at it on an overall basis, whether are you the principal in the transaction or the agent in the transaction. US GAAP is a little different. US GAAP has this as the primary criteria, and then it has these 2 as secondary criteria, and it has a couple more. So it says if you meet the primary, you're done. You don't need to go to secondary. If you don't meet the primary, then you go to secondary and then make an assessment. So that way, US GAAP is, so your answer in US GAAP and IFRS could end up differently. Here it is an assessment of all 5 criteria. Similarly, your sales returns. We have not seen any major differences between Ind AS 18 vis-a-vis Ind AS 115 on sales return. You go through that same process of estimating your returns and correspondingly recognize a provisional liability to that aspect, and the sales return is net off from revenue. One important thing from the transaction price perspective, some of these discounts, penalties, volume rebates, a lot of times we see companies showing it as expenses as against net of revenue. Ind AS 115 has kind of removed that ambiguity in terms of how some of these expenses are accounted for. The fact that it is used as part of determining the transaction price, you net off revenue. You don't show it as a cost and a liability separately. So from a sales return perspective, again, it's very similar to Ind AS 18. You would still make your estimates and identify your sales return, and that whole rule of significant reversal of revenue should be borne in mind when you're recognizing sales return, that there is a differentiation between sales return and whether you should recognize revenue in the first place. So if it is a case of highly probable that there could be a significant reversal of revenue, you don't recognize revenue in the first place. You can't recognize revenue and bring in the harbor of sales return against it. So that is one area where people need to be mindful of, that what is not recognizing revenue in the first place vis-a-vis sales return itself. Now coming to the warranties question, and this has stemmed out of what are the performance obligations. So this flowchart should help. Does the customer have the option to purchase the warranty separately? Yes, it is performance obligation. Are additional services provided as part of warranty? If it is yes, performance obligation. And if it is no, it is part of your normal sale. Within cars, or say for that batteries example also, if the standard industry practice, say in case of cars, is 3 years and 60,000 kilometers, that's the standard business practice. So most of the companies have taken the position that it is standard warranty and it is part of your revenue itself, not a separate part of your revenue of your car itself. It is not a separate performance obligation. Please don't mistake this for the extended warranties sold, which is year 4 and 5. So say 3 years, that cost is itself. But say a particular car brand decides to give 10 years warranty and maybe include roadside assistance also in it, then there are additional services as compared to what is standard as per industry practices. And there could be a case for a separate performance obligation. And that performance obligation would end up over a period of time as compared to a sale of a car, which is at a point in time. You would need to allocate revenues separately and recognize. It can become a very tedious task in such perspectives, because then you would have to identify the transaction price for that additional warranty what you're giving, and to have a mechanism to recognize over a period of time as compared to recognizing everything upfront. So this is an area which needs to be washed out, especially where your warranties you are providing on your products are very different from what is the general industry practice. One could raise a case in terms of is there an additional performance obligation present in terms of the additional warranties you are providing within it. From an application standpoint, you've seen companies wriggle out of it, right? Because if you come to an answer where there is a separate performance obligation, the effort involved could be very significant from that perspective. So, sorry. A manufacturer N sells to customer A car, a standard warranty 3 years or 36,000 miles, plus an extended warranty, additional 3 years or up to 70,000 miles for INR 5,000. How many performance obligations are there in the contract? So there are 2 performance obligations. One is the car and the standard warranty of 3 years and 36,000 miles. And separately is the extended warranty, which is for year 4 and 5, or an additional 3 years or up to 70,000 miles, which is another 34,000 miles. So your standard warranty, whatever revenues are allocated means it's already included within the car price. You just make a separate provision on the standard warranty. In automobile industry, we have seen different types of warranties as a cost recognized. Something called as goodwill warranty also, that if the goodwill warranty we have seen in multiple cases where what if a claim comes just after the warranty period gets over. So say you are giving a 3-year warranty, 36 months, the claim comes in the 37th month. And many organizations, many reputed companies, they still consider it as part of warranty because it's not like a hard stop that the product will work only up to 36 months and 37 months onwards, it will not be a great product. So we see goodwill warranties, but again, those goodwill warranties are treated like costs and provisions are created as part of Ind AS 37. Coming to extended warranties, there was a question on the discounting impact. So the way extended warranties are computed also, they are computed on present value basis. So yes, that discounting impact is included into it and needs to be unwound when you go ahead and start recognizing that revenue. So if as extended warranty amounts are paid upfront, say for year 4 and year 5, and if you see within cars also that when you are buying extended warranty, when you buy the car, the price for year 4 and 5 is the least post, say after buying the car 1 year, 2 years, or before the standard warranty expires. So that discounting impact is included within the sale price also, and you as a company would need to unwind that discount when you're recognizing revenue, because you're getting upfront cash for it. So your revenue amount would be higher by whatever that implicit interest cost is included in that amount. So yes, I hope I've answered that question on extended warranties. So if you're giving 10 plus 2, I think that was the question. If 10 years was the standard warranty, then you wouldn't have a separate performance obligation. That plus 2, if it is free of cost, right? You're not selling it as extended warranty, but you're moving away from the industry practice of 10 years, then you need to see whether that 2 years is an additional warranty you're providing, and hence you need to carve out that amount from the sale price of that battery. Or if it is 2 years of additional warranty which the customer can buy, then it itself is a separate performance obligation, and you would need to take into account the unwinding of interest cost to it. In terms of disclosures, Ind AS 115 requires a lot of disclosures. So yes, you need to disclose appropriately. One, all your revenue streams. You need to disclose appropriately what your revenue streams are and how you are recognizing revenue at a point in time over a period of time. If there are any adjustments which are made towards the transaction prices, you need to disclose for that. You need to give some amount of disclosures towards your customer profile also. So what's the concentration of customers you have in terms of certain sets of revenues. So it's far much more than what was required within Ind AS 18. When we've worked with number of clients, we've usually seen very generic accounting policies in terms of recognition of revenue, and it doesn't give the user any indication in terms of how revenue is recognized. I think the accounting policies should be appropriately documented. At least it should give a proper flavor in terms of, one, what are the different revenue streams and how they are getting recognized. Means at no point would it happen that you're giving away any competitive information to your competitors from that perspective, but at least from a user of the financial, maybe any financial institution should get a good who's trying to lend you money, or any potential investors trying to understand your business. It should give enough information to that user that how the company is generating revenues, and hence there is quite a bit of disclosures required within Ind AS 115. So we're towards the end of it, and we'll have at least 15 odd minutes to go through any Q&As we have and go through. In the break, I saw there was some questions within the chat also, and we'll go through that. So we spoke about the 5-step process within the new revenue recognition model, which is 1, identifying the contract, 2, identifying performance obligations, 3, determine the transaction price. 4, allocate the transaction price amongst all the performance obligations you've identified. And 5th is recognizing the revenue either at a point in time or over the period. Now the new model is on transfer of control. Risk and rewards is only now within one of the criteria within transfer of control. You need to separate all your performance obligations. So if there are goods and services involved, a lot of times we see in installation cases also, that if installations are so specific that no one else can do it. So you're selling a good or a machinery, or it has to be installed by that manufacturer itself. Then there is a potential case of 2 performance obligation being there. One is the installation of it, and 2, or rather 1, the sale of goods, and 2, the installation service. Variable consideration we spoke about. We need to look at all discounts, incentives, rebates, even penalties on day 1. It's not about recognizing them at the end of the year. It has to be recognized as and when the sale is made, because it's part of your determining the transaction price. So transaction price you identify based on the standalone selling prices, and then allocate using the relative fair value method. If you are unable to get observable prices, you can use the cost plus margin approach. And one of the methods allowed also is the residual approach. There are a significant amount of estimates and judgments involved. Many of these could have a pervasive impact from an auditor standpoint, that if you're aggressively recognizing revenue or even conservatively recognizing revenue, it can lead to a lot of questions on your estimation process. So you need to be mindful of how you go about that process. With this, I'm done covering Ind AS 105. I can take all questions you all may have, or we can go through the chat as well. Sorry, I see some messages saying, can you please explain once more? But I don't know at what point in time that was asked. So if anyone has questions and needs further explanation, happy to provide. You can unmute yourself.
Screens of I will add you in the spotlight, sir. Stop sharing the screen, sir.
Stop sharing the screen. Stop sharing. Okay. So I see a question from Sanjay. Is upfront discount recognized over a period of or initial stage? What do you mean by that, Sanjay, if you could comment? Sanjay? Do we expend the discount on the... So it's not about expensing the discount. That is determining your transaction price. So say if we were to look at that mobile phone and mobile wireless services example. So I think we had come to an answer of 162 and 258, right? Or 168 and 252. So you would recognize 168 on day 1. So 32 rupees worth of discount you have recognized. But the remaining 48 rupees of discount you would recognize over 12 months, because that's the discount on the mobile services. So that 48 would get recognized over 12 months from that matter. So that discount, upfront discount, what you're giving as part of bundling is actually allocated between the transaction price, and it would only get recognized as how the revenue recognition principles are. Prasad has made a comment, the right to return is optional. So how the seller can provide for liability and important. So like I mentioned, sales return, nothing different on from Ind AS 18. You basically estimate how much returns are you going to have. And generally people tend to look at historical data, that historically what products have faced how much returns. If it is a new product, you assign or you compare it to a comparable product. So in FMCG, it is very common in terms of, or rather in pharma also, sales returns are recorded for expired medicines also. So the pharmacies have the ability to return back any medicines which approach the shelf life, right? So most companies are able to determine a percentage using historical data. They are able to do that. So Mani Kumar has a point. Commercial transaction will differ between customer to customer. How, as an auditor, to comply the standard? Is it required to review all transactions? So as far as and the way we have approached, you bucket the transactions. The management should be able to tell you what transactions are similar, and you do your normal sampling. You look at 4 to 5 contracts within each and every bucket, and also speak with the sales and marketing team. There you might get few surprises because they really are blindsided on the finance side. So they will give you the true terms and conditions in terms of how it works and what they have gone and committed to the client to make that sale happen. So a lot of times bill on hold transactions you see to meet monthly targets, year-end targets, they go ahead and bill invoices and the goods are supplied after the month. So those kind of things you'll come to know once you speak to the sales and marketing teams. So the question above by Akshay Jain is, sir, in the above example, if providing of mobile phone was optional and the customer opts for the mobile phone, will there be allocation of revenue? So yes, means that's the reason how you have an observable price, that people have the ability to buy only the phone or mobile service. But if you end up buying both together as a bundle, then you have to go through it. If you're going to buy it separately, it will remain as it is. So it's only in case of bundle contracts. Karthik has made a point, if we go by the residual approach in the example given by you, the tax authorities may not agree. How do we deal with that? I wouldn't expect significant variations in margin as far as your client is aware of what the implications are. So the margins, what residual approach ensures is that margins are appropriately divided between the delivered and the undelivered items. I would be really surprised to see significant differences in margins in the residual approach. in reverse residual approach, you had the ability to recognize more margins. And if you're recognizing more margins, I'm sure the tax authorities will not have a challenge. Murli has a point, sir, if the service warranty is for several years and there is time value of money involved also. So that you would factor in when you do your IS 37 provision for whatever service warranty you have, which is standard industry practice. A lot of that, and as I've worked with a very large automotive company, they have pretty scientific calculations in terms of that. And it gets as detailed from a car's perspective, part by part, which parts are going to be replaced. Raman has another point. Can the interest rate on delayed payments be considered? So interest on delayed payments would be other income. It would not be revenue. Vipin, if customer can sever the mobile services and use some other mobile company, sorry, I lost it. Can use some other mobile company service with the same device, is that probability to be considered in recognizing the consideration? So I've seen this a lot in the US, where the free handset concept is there. So usually there are penalty clauses involved, that if you walk away from the free handset, means you take the free handset and try to move to another service provider, you would have to pay for the entire handset. So you don't need to take that consideration. It's just that additional revenue recognition will happen. The whatever penalties that customer pays, you would end up recognizing as revenue.
Sir, Ramanan sir has raised his hand. I am muted.
Yeah, sir, thank you. See, the thing is, my question on the interest was whether it can be used for your significant performance, significant financing component.
No, there is, okay. Significant finance, and thank you for asking that question. Significant financing component only comes into play. You have negotiated a credit period. Okay, so say I give you certain goods and services, and the credit period I have offered to you is 60 days. But you pay me after 2 years. You have not done any financing. Means I have not done any financing to you. Okay, so if I recover any interest on delayed payments from you, there is only other income. There is no financing involved. Okay. So a lot of times we see with government entities, okay, where the negotiation itself is that we'll pay you after 18 months. Then there is significant financing.
Okay.
Okay. And be mindful. Say you, the practical expedient is for 12 months or less. Say if you give 13 months, that doesn't mean you do discounting or that impact for only 1 month. You have to do it for 13 months.
Okay.
Only because it is 1 month more than, so it's not minus 12 months. So every 24 months, you don't minus 12 and do discounting for 12. You do it for entire 24.
Okay.
Yeah.
Thank you.
Thank you. Anyone else has? I think we are on the mark. If 4 minutes over. If there are any additional questions, comments.
There are no questions.
No. All right. So thank you so much. Thank you, everyone. Thank you for spending the time out here. Hope you found this session useful. You put up my contact details. Anytime you have any questions you want to clarify, feel free to reach out. Happy to help. I think this slide deck will be shared with you by today, tomorrow times, and you should have it. I think Priyanka
Sorry, sir. And Vipin sir and Priyanka ma'am has like raised their hand. Shall we take their questions?
yeah, yeah.
Arswini sir, I'll mute yourself. Sir, you can unmute yourself.
Just one question that in the examples that you had mentioned and discussed as your experiences also well, there are significant ways in which the business is carried out and the way the contract has been structured. And while we try to comply with Ind AS requirements or IFRS requirements, whether it may require even the contract to be reworded or rephrased in order to have a clear position accounting proposition. That's what I just had a doubt.
That's kind of a thing I do for a living. So a lot of times we have companies who take an initial assessment. They tell me how revenue would be recognized, and we give an X answer, and they don't like the X answer. So they come back and say, okay, why did you come up with this X answer? Which was that clause which bothered you the most? So before they formally sign up on a contract, see, I've been, so the type of work what we do, in India, accounting used to be a little reactive, and I've seen this position change. Now finance teams are very proactive. Earlier deals would be done, everything, and papers would just come for accounting, and you might not come with the best of answers. Now things are very different. Before even means they start looking at revenue contracts at the draft stage itself, especially if they're material in nature. So yes, people look at clauses, get that if I change a full stop from year to year, will it make an impact? Will it change the answer? So yes, you can look at the wordings of your, and post facto, once the contract is signed, then is a done deal. You cannot do much. Yeah. When Priyanka was there, does she have a question still? Or she is?
Okay. That's it. Thank you, sir. Now
Thank
I
you, sir.
want our past chairman Vatsmali sir to give order of thanks.
Excellent presentation by Sri Akil Masterji. Excellent, and we are able to see your vast experience in your presentation, and you are able to give good presentation, and we are very happy. And thanks for your sparing your valuable time, particularly in the last minute. You are always available for us. Thank you very much. Thank you all. Thank you.
Thank you.
Thank you, sir.
Thank you.